For joining me. This is the Crypto Minute. My name is Russell Shaw, Senior Market Specialist at FXCM. Email address rshaw@fxcm.com, and the date, of course, Wednesday, 25th of May, 2022. I'm just going to bring up our high-risk investment warning and, of course, our commentaries disclaimer. And I caught myself in a mistake from the last webinar. It's not a biggie, but I think that it's worth just mentioning the mistake. Here's our market commentaries disclaimer, and here's our references. And what we'll do is we'll just bring up the crypto charts. We'll have a quick conversation with the DAX because Anna made a good point just as we were ending the previous discussion. But just before we get on to Anna's point, my mistake is, let me just get rid of this, is that the correlations don't go to -1, they go to +1. So it's very important that -1, just to give you an idea of the difference, -1 suggests that all the instruments move opposite to one another. They perfectly inverse to one another, right? That's not what happens in a bear market. In a bear market, they become very much correlated with one another. There's no place to hide. That's called a positive correlation. Okay, everything lines up and positively correlated. Even though we're heading down, everything's moving down together. That's actually a positive correlation. Sorry for the confusion there. I just wanted to clear that up. I think, Anna, also just having just thinking about your comment as I was jumping between the webinars, is of course you're 100% correct. What Anna said is, well, the German companies are facing crises from natural gas, from I would suggest from energy, the energy market as a whole, and I would also suggest that Europe as a whole is much more exposed to stagflationary pressures than the US is. I agree with all of that, and I would say that is an extra layer of resistance at this 15,000 level. So the idea here is, can the market participants, the portfolio managers, the pros, have enough power to push above this 15,000 level? And I think that's the question, because you can see that there is a whole layer of complexity and adversity facing the risk markets. And again, I would suggest be careful in a bear market because everything tends to that correlation of 1. So even though there is 100% an outperformance in terms of DAX against the US 30, we must still acknowledge the complexities here. Having said all of that, if there's any questions, of course, go ahead, type those in. Let's take a look at Bitcoin. And I'll bring that up. All right, so this is a chart that I put in on. I wrote an article on, and I put a target. I kind of sheepishly do so because I'm not a big fan of using targets because they might be hit, but who really knows? Let's be honest. Forecasting is just it's a fool's game, right? But those are the articles that get the most interest. So there is this sort of topping pattern here, and you've got a left shoulder here. You've got a head over here, and you've got a right shoulder here. There's no doubt about it that this is a reversal pattern. I think that is quite clear. What's certainly not clear is whether the target of this pattern is 16,000, okay, which is what this pattern's measured move gives. There are complexities in measured move on a few levels. The first level, let's just talk about it in terms of technical analysis. The first level is there's no real literature that I've come across which suggests which scaling you should use on the y-axis So what does that mean? Well, do we use a logarithmic scale or do we use an arithmetic scale to get our targets? In this case, it seems to be suggesting similar. I don't think that's quite accurate. Let's just redo that again. Let's just see. Yeah, you see, yeah. So once I've changed it to the arithmetic scaling, the target is just completely different. And let me do this again. I mean, it's off the chart. I can't even get to the bottom target. So there's no real literature that I've seen which suggests logarithmic or arithmetic for measured moves. That's a big problem, okay? Because I would think, and this is just really a guess. I would suggest logarithmic is probably what you want to do on longer term charts, and arithmetic on shorter term charts, but I've got no supporting evidence for that. So that's a big problem. Number two is, so that's number one. Number two is, well, I mean, what's the sense behind the measured moves? Is there truly a symmetry in the market? You know, and I would again say that sort of measured moves work just enough times to keep people interested. So whether we hit the 16,000 or not is not really the point. I don't think that's the point. I think what the point is actually the pattern. The pattern says a lot here, okay? And why does the pattern say a lot? Well, let's get rid of all of this. Let's just get rid of all of this. Forget about this part of the pattern. Anything to the left of our blue vertical, forget about it. Let's not even consider it for the time being. Let's just consider the price action to the right of the pattern, okay? Well, this, I think, is more useful because once we consider the action to the right, now I think we've actually got something that we can work with, something that's sensible to talk about. And then what is that? That's a trend. And what kind of a trend is it? It's a downtrend, okay? And let's put in our peaks and troughs. We've got a reference peak, okay? We've got a reference trough, okay? Once you've got the references in, it becomes quite clear that we're in a downtrend because we have a lower peak and we've got a lower trough. Now, an assumption made by technical analysts, and this is probably something that I would agree with, is that a trend is considered in force until it's not. Because and the reason why I think we've got to work with that is because the financial markets are so complex, there's so many variables to it that we have to have some sort of structure to work with. And I think trend analysis is one of those structures that is workable. So the fact that we've got on a weekly chart a lower peak, lower trough, well, now we can combine that with momentum. Now look where the momentum's going, okay? The momentum is dropping into that 20 area, and that to me is actually the big danger. Yes, we've got a downtrend. Yes, it probably is in force until it isn't. Well, if it goes like this, and it goes like this, and then it goes like that. Well, that's it. Now we don't have a downtrend anymore. We've now got an uptrend because we've got a higher trough, higher peak. So there's the structure that we can work with. But what is concerning to me is this negative momentum, because if the negative momentum persists, now that's the key, persisting. If it persists, then we will see lower prices. There's not much that we can say to argue against that, okay? Momentum is generated by market participants. Think about it in terms of energy. It's kinetic energy, okay? So what happens is if we get persisting downwards momentum, then we can certainly get to that target of 16,000. Now, the target of 16,000 may be hit, it may not, but if there is seriously a weak momentum here, it does make that target more plausible. And if 16,000 gets hit, you know, then I'll write an article saying our target was hit. But to be honest, it's luck more than anything. The idea here is where the momentum is heading now. That's the important part. That's what we keep our eye on. If it hits 20 and rolls up and starts moving up, that to me is the best development for crypto bulls. If we stay below 20, then the crypto bears are going to be celebrating because we will see lower prices. So in terms of the technicals, we can see that Bitcoin is under tremendous pressure. Now, what is the fundamental reason? What is the fundamental reason? And I don't think that we have to look far to find fundamental reasons for cryptocurrency capitulation yet. First and foremost is the the Terra/Luna debacle. Okay, that was just if there's something that's going to injure any sort of confidence in cryptocurrencies, that was it, right? A currency that's going to be a stable coin completely going belly up. That's not something that we want to see if you're a crypto bull. But I actually would regard that as secondary. I would regard that as secondary. Okay, to be quite fair, I didn't really pay much attention to Terra or Luna before the news broke, but I was consistently paying attention to Bitcoin. Bitcoin is the far biggest crypto out there, and I think the most important by far. So again, I think the sensible approach to this is, well, what's the dollar doing? And I think that is the key here. What's the dollar doing? Because this is reflecting monetary policy, and monetary policy is really what is being discounted in the risk markets. So if the US dollar is the link for Bitcoin towards fundamental analysis, then we need to use it. And that being the case, we must then take a look at the US dollar. Okay, so let's go ahead and bring up the US dollar here and see what is happening here. And the problem for Bitcoin, okay, is that the US dollar, to me, is setting itself up for another leg higher, subject to correction. Okay, it's setting itself up higher, subject to correction. In other words, what am I saying about this? Let's bring in that RSI. No. Can you guys hear the birds? It's a beautiful day here. My window in the office is open, blue skies, and all right, let's just take a look at the RSI. And what I really like about the RSI is its risk control application. Okay, not really anything signals in terms of trading, which you can, again, you know, indicators are very personal. You use what kind of works for you, and clearly a lot of traders like the RSI. For me, I do like it, but I like it in terms of measuring a skew on risk. And the dollar had a skew on risk. Okay, there was a price cap. We mentioned this yesterday. Why was there a price cap? Because it's unlikely to stay above 80 for a long period of time. And well, guess what? We've normalized. That's bad news for cryptos. The pullback in the dollar, okay, would be supportive of Bitcoin because the US dollar is the denominator. So as the denominator comes down, okay, the numerator must benefit, all things being equal. So this pullback here certainly would be bullish for Bitcoin. Let's take a look, see how Bitcoin reacted over the last 2 weeks. Okay. Well, it's stabilized. It hasn't been a great 2 weeks for Bitcoin. Okay. It hasn't been a great 2 weeks for Bitcoin. there's no real ranges here. There's no real ranges here, but it hasn't done anything. It's just stabilized. It's moved sideways. So the question is, why is it stabilizing? What's the factor that's causing Bitcoin to stabilize? Is it the numerator or the denominator? Well, I would suggest it's the denominator. How can I make that claim? Because we've just gone to the US dollar. We've seen that the US dollar's pulled back. That has to benefit the Bitcoin. And if that's benefiting the Bitcoin, there's the stabilizing after this leg down. After this leg down. Well, that's frightening, because the next piece of our puzzle, okay, the next piece of our puzzle needs to go to the US 10-year. You need to go to the US 10-year, all right? And we're looking at weekly charts here. We're looking at weekly charts here. And the idea behind the US 10-year is, again, trend analysis on a weekly time scale. On a weekly time scale. Before we do the trend analysis, the yield had a ceiling on it. The yield had a ceiling. It must have had a ceiling on it because it was overbought. That's normalized. So I was listening to Bloomberg. There is a very good fixed income analyst that works for Bloomberg, a gentleman by the name of Ira Jersey. Really, really good. If you can listen to him, I would recommend it. His interpretation of the pullback in the 10-year yield is, well, perhaps the Fed cannot move as quickly as the market was pricing in. And that is certainly plausible. That is certainly plausible. So we mustn't just, if the Fed cannot move as quickly as the market suggested, that would be a tailwind for Bitcoin, because it would be a headwind for the US dollar, right? However, let's put a slightly different spin on this. What happens if it was a market reaction here because of the froth in the bond market? There was certainly froth in the market because market participants have taken yield up at a tremendous speed. If it was just a pause in a larger uptrend, well, let's put in the peaks and troughs, okay? Because that's a framework we can work with. So we can put in a trough. Let's put in the peak. And once we've got the references in, trend analysis becomes much easier. And you can see here is your higher trough. All right, here is your higher peak. Here is your higher trough. Here is your higher peak. All right. Now, the question is, what happens now? Well, as we mentioned earlier this morning, is that in technical analysis, we suggest that the trend is going to continue until there's obvious evidence that it doesn't. So it's quite probable that we get a higher trough here. And if we get a higher trough here, then we might get the higher peak. And if we get the higher peak, okay, then the uptrend continues. If the uptrend continues, well, that I would suggest would be dollar supportive. And if that's dollar supportive, then of course that's going to weigh against the Bitcoin. Rob asks a brilliant question here. Okay, what about the head and shoulders on the daily? Okay, so I actually saw a tweet, and for the first time yesterday, I saw the head and shoulders on the daily. So this is what you are referring to here. There's our left shoulder. Here is the head, and here is the right shoulder. So I think that it's quite obvious there is a topping pattern. And if we connect the headline, it does in fact look as if it's breaking down. And I guess the only answer that I can give you, Rob, is, well, if this is the case, then perhaps the scenario put forward by Ira is, of course, the correct one. Perhaps the market then was discounting too much by the Fed. So that would feed into this head and shoulders top. Let's assume that is the way that the market goes, Rob. Let's assume that we have got this head and shoulders top playing out. Then we will eventually see that on the. Then we will eventually see that on the weekly, and we would see it as something like this. Okay, we would see it as something like this. So it would be silly to ignore the fact that. Oh, sorry about that. It would be silly to ignore the fact that the yield cannot come down. So now let's perhaps take a look at this in slightly different way, and see which is the more obvious possibility. So the question then becomes, well, what would be driving yield? What should be driving yield? And I think that we would all say, well, it must be inflation. So if it's inflation, then let's combine this with an inflation analysis and see if that is in fact the case. So what we'll do here is we've got a very specific model that we're using to try and track inflation. There is a complexity that's been introduced. I'll show you what it is in a moment. But let's go and bring in our PPI. All right, I just need to get rid of logarithmic here. We won't need it. And there is a clear hinge in the PPI here. Okay, so that would give obviously a tick mark to the fact that yields coming down. It would give a tick mark, a check to the daily head and shoulders pattern. But let's carry on with the analysis. Okay, let's take a look then at the CPI. We're going to look at it in terms of core. See, let me just remember this. This should be okay. I'm going to put this on a new price scale. Okay, and all right. So what we want to look here for, I think, is actually the cross of PPI and CPI to the downside. I think that's something that is going to help in terms of the yields coming down. Let's just add in a few other. Let's add in now the Fed's funds rate. Okay, so this turquoise here is the Fed funds rate, and to me, this is, I think, a key piece of the puzzle for us to keep an eye on. Every time we've had these huge stagflationary pressures, so this would be the first oil crisis, this would be the second oil crisis, this is the current oil crisis. We've already had a Fed that has been acting very, very forcefully indeed. By the way, these would be the Volcker years. Paul Volcker was incredibly hawkish. And the question is Jerome Powell going to follow the Volcker approach? That is in itself I guess, an unknown. Comments suggest he's looking to approach the Volcker. He's looking to use the Volcker approach of heavy-handedness in terms of forcing the inflation rate down. Okay, at the moment, that's just lip service, isn't it? That's just lip service. The Fed's fund rate hasn't done nearly as much as it's done on the previous supply shocks. Okay, so the big question mark there. So I would think the answer to our question, to our conundrum, Rob, is, well, what happens over here? Are we going to do a Volcker type of rate increase? Then I don't think the head and shoulders can hold. Do we be a little bit more moderate in the approach? Then I think the head and shoulders can hold. Okay, so this I think is the big question mark. By the way, if we do follow a Volcker-esque approach to the market, that introduces another massive hit that we're going to have to deal with. What's that? That's unemployment. Okay, so let's bring that in. All right, what do we got here? Where's the unemployment? Is this yellow? All right, this is really getting messy now. Let me just see if I can clean this up slightly. I'm just going to use an area here. I think this makes it a bit easier if I make it sort of a like that. Yeah. Okay, that looks better. So this area chart here, that is unemployment. Okay, that's unemployment. Take a look at unemployment during the Volcker years. Okay, here is the heavy-handedness of the Fed. Here is the increase in unemployment. Okay, here is the heavy-handedness of the Fed. Here is the increase in unemployment. Okay, the Fed must know this. Okay, take a look where we are in terms of unemployment now. It's very, very low. It is very, very low. That's a good thing. That's a good thing. But it comes with a risk here, Rob. What's the risk? Well, whilst we've been looking for the crosses in terms of PPI and CPI and doing some analysis that way, what about the crosses of unemployment and the federal funds rate? So take a look here. Do you understand the question? Here, the federal funds rate crosses above unemployment. There's a lag, and then unemployment increases. Okay? Here is the bullish cross, or let's call it a positive cross of the Fed's fund race. Here is the unemployment. Looks like we're about to get across here. See that, Rob? So that's just interesting. How does that fit in to our analysis? Well, it fits in well. If we get this Volcker type move, I would suggest we probably see higher rates ahead. But there's a question mark there, right? Will we get that? I don't know. The Fed is certainly talking it up. The Fed is certainly talking it up. And that, of course, brings us all the way back to this chart here. Okay. The way that the market seems to be pricing it in, well, take a look where the momentum is. That's, I think, the key. Are we going to hold that 20, or are we going to move into that 20 and then move out? Okay. And I think this is going to be very much a function of how the inflation chart we just analyzed plays out. Do we get that Volcker-esque move? And that would largely determine the momentum of this chart. And that momentum of the chart, I would suggest, largely determines if that 16,000 is going to be hit. Any questions around that? Thank you, Zanetta. I'd like to see that. Please do. Yeah. Any questions around that? By the way, it's not only the Bitcoin market that would take the hit there. Bitcoin market is acting very much as all risk markets. So the risk markets are at risk as well. All right. Let's conclude at this point then, guys. You have my email